Hi there. My name is Jeremy Anderson. I'm one of the notaries public at Old House Notary here in Courtenay. Our client-centered practice assists clients with estate planning by drawing wills, powers of attorney, and representation agreements, and with helping clients buy, sell, and finance real estate. And today I'm going to talk to you a little bit about vacancy taxes. There's vacancy taxes at all levels of the government here in Canada. At the federal level, we have the underutilized housing tax. At the provincial level, we have the BC Speculation and Vacancy Tax. And at the municipal level, the City of Vancouver has what is colloquially called the Empty Homes Tax. My focus today is going to be on the BC Provincial Speculation Tax. Now, the BC Speculation Vacancy Tax came into effect in 2018. BC residents and Canadian citizens and permanent residents who aren't eligible for an exemption will pay the tax at a rate of 0.5% on the assessed value of their property. Foreign owners and untaxed worldwide owners, otherwise known as satellite families, now pay the tax at a rate of 2% on the assessed value. Now, it's important to understand that the NDP government during the last provincial election indicated that they would double those rates in their next mandate, so we'll likely see those increase in the near future. Now, when it was initially introduced, this tax was applied to the assessed values of properties in certain geographic regions. In 2023, it was expanded to add 6 additional communities, and this year in 2025, 13 additional communities were added to the list of affected areas, and that brings the total number of affected communities to 59. Now, importantly for us here in the Comox Valley, those 13 new communities include the City of Courtenay, the town of Comox, and the village of Cumberland. Now, the tax applies to whoever is the owner of a given residential property on December 31st of each year in any of those affected regions. So if you're an owner of a property on December 31st, this tax is going to apply to you. Now, that doesn't necessarily mean that taxes are payable. And whether there's taxes payable depends on the use of that residential property, the owner's residence status, and where the owner earns and reports their income. Now, the rate of tax that gets applied depends on a number of factors as well, such as the owner's residency status for income tax purposes. And in this instance, the same meaning is given under this Act as under the Income Tax Act. So in other words, whatever position you take in terms of your residency status for your personal income taxes is the same that's going to apply for this provincial spec tax. Now, there's a distinction to be made between residency status for tax purposes and for residence purposes in the ordinary meaning of the word. So in other words, where you pay your taxes is not necessarily where you hang your hat. And so what the government, I think, is trying to do with this tax in this instance is make a distinction between whether you're a foreign taxpayer and whether the property is vacant for the purposes of this tax. Now, this tax also refers to the concept of untaxed worldwide earners, or what's also referred to as satellite families. And these are families where the majority of the combined spousal income of property owners is earned outside of Canada and therefore isn't reported on a Canadian income tax return. So let's say, for example, you have a family where one spouse works and pays taxes in the United States while the other spouse lives with their children in British Columbia. Now, in that case, speculation tax will be payable unless the couple have other income that's reported on a Canadian income tax return that's greater than that income that was earned and reported in the United States. And in that case, they would be considered to be untaxed worldwide earners under the meaning of this Act, and they wouldn't be exempt from the tax. And that's even if the spouse who lives and works outside of Canada is not on title to that property. So you can't get out of it by not having the untaxed worldwide earner not on the title of the property. And if there's multiple owners of a property, the amount of tax owing gets divided among each owner based on their proportionate share of the property. So let's say, for example, you and your spouse are equal owners of a residential property, and you're in a taxable region, and no exemption applies to you. You will each owe tax on your 50% of the home's assessed value. So for example, if you have that same Canadian couple, and they earn the majority of their combined income in Washington State, and they own a vacation property in British Columbia that's worth $1 million, if they don't qualify for the exemption, they'll be taxed at the highest rate. And in that case, they would each be liable for $10,000 of tax, which is a total of $20,000, and that's based on that 2%. Now, if you're not eligible for any exemptions from the tax, you may still be eligible for a credit that would get applied to the tax that you have to pay. And for BC residents who are Canadian citizens or permanent residents and who are not those untaxed worldwide earners, that credit is up to $2,000, and that's based on your proportionate ownership interest. And it gets applied automatically to the amount of taxes that you have to pay, provided you qualify for all of the criteria. And for all other owners who are not BC residents and Canadian citizens or permanent residents, there is a credit on the tax only to the extent that they would have BC income. And lastly, where a corporation or a trust owns a property, they are taxed at the highest rate that would otherwise be applicable to any of the corporate interest holders, beneficial owners, or partners, as if they held the property directly. So let's say, for example, a corporation has 3 corporate interest holders, and it owns a property in Vancouver that's used for, say, vacation home for friends and family. If one of those corporate interest holders is an American citizen who reports 100% of their income in the United States, even if the other 2 corporate interest holders are Canadian citizens and BC residents who do report 100% of their income on a Canadian income tax return, all 3 of those corporate interest holders would be subject to the tax at the highest rate because that one corporate interest holder was considered to be an untaxed worldwide earner. Now, I've been talking about some exemptions to this tax, and there are a few of them. Most notably is the principal residence exemption. And there's a couple important things to note about that. First, if you have multiple homes, you can only claim the principal residence exemption on the home that you lived in for the longest period of time during the calendar year. And spouses cannot claim 2 different exemptions unless certain circumstances apply. So, for example, if they lived and worked apart, or if they had to live apart for medical reasons, or of course on the breakdown of their marriage. Also of note is that the principal residence exemption is not available for foreign owners. Now, when the property is occupied by a renter or a non-arm's length tenant for at least 6 months in the calendar year, the owner may be exempt from the tax. And this is important to be aware that 6-month total does not include periods of 1 month or less. So in other words, short-term rentals of 1 month or less don't apply to that 6-month total. And the tax makes a distinction between arm's length and non-arm's length tenants. And the difference is that to qualify as an arm's length tenant, there has to be a written tenancy agreement, and the tenant has to live on the property. And so this is really important to be aware of for landlords, because one potential issue here is that whether the owner is exempt from the tax is entirely dependent on the actions of their tenant. Because of course, if the tenant doesn't reside in the property, the owner loses the exemption. And obviously that's not within the control or power of landlords. So from that perspective, landlords who want to rely on this exemption should probably include a provision in their tenancy agreement that requires the tenant to actually occupy the property, rather than simply giving them a right to occupy the residence. Now, on the other hand, a non-arm's length tenant, such as family or friends, they don't require a written tenancy agreement. But the tenant still has to reside in the property for more days in a given month than in any other place. So in other words, that tenant has to live there at least 50% of the time in each month. There's also an exemption for uninhabitable properties, but this only applies if the property was not already uninhabited. So let's say, for example, that it becomes uninhabitable for 60 consecutive days due to a disaster or a hazardous condition that's beyond the owner's control. Only in that case would they be eligible for the uninhabitable exemption. And because the tax is levied against individuals, when we have more than one owner on the title to a residence in a taxable area, each owner has to claim their own relevant exemption. So that means, for example, where there's shared ownership, there could actually be 2 different exemptions that apply to the different owners. And a common example where we might see that is where a parent co-owns a property with their adult child. If the child lives in the home and the parent lives elsewhere, in that case, the child could claim the principal residence exemption because they live there, and the parent would claim the tenancy exemption because they effectively have a non-arm's length tenant in those adult children. Now, how does the declaration process work? Well, declaration letters are mailed out in phases based on postal code, starting in the last 2 weeks of January through to the first 2 weeks of February each year. So basically, those letters are starting to go out right around the time that I'm recording this blog. And they get mailed to the registered address that's on the title of the property. You then have until March 31st to make your declaration using the instructions that were in the letter that came to you in the mail. And just like your municipal property taxes, any taxes that are payable are due on the first business day in July. Now, if the owner happens to be deceased, only the executor or personal representative can declare on their behalf. And that person will need to have some sort of evidence like a will to prove that they are authorized to act on behalf of the deceased. Now, what happens if you don't make a declaration? Well, first, if you fail to declare before the deadline, you'll be automatically assessed at the maximum rate, that 2%. If you then fail to pay the tax, you'll be assessed a 10% penalty plus interest on the unpaid taxes. And if you continue to fail to pay, then the government is going to look to do things like connecting with CRA and see if you have any refunds that are due from them that they could get a hold of. Or they're going to look at your sources of income through CRA and your personal income tax returns to see if there's any income that they can garnish. They're also going to seek to identify any property you own that they can seize or lien. So it's really important to make sure that you get on top of these declarations and paying any taxes that are payable.